This is Behind Closed Deals.
We'll be chatting with multifamily maestros,
Uncovering their strategies
and unraveling the latest market happenings.
bringing you intel you can't buy.
Well, hello, everybody. Good afternoon, and welcome to Behind Closed Deals. I am George Tikijian with CBRE here in Indianapolis, and we are so fortunate today to have with us Ivan Barratt. Ivan is the founder and CEO of the BAM companies, formerly Barratt Asset Management. And I am a piker compared to Ivan when it comes to podcasts and marketing. Ivan is one of the best in the business. So we are very fortunate to have him, and we look forward to having a conversation with Ivan today, but a little more background. So since 2015, Ivan and BAM companies has raised nearly $400 million in equity and has acquired over 8,000 units and managed over $1.3 billion of assets, multifamily assets. BAM Companies is based here in Indianapolis, and I'm going to let Ivan describe when the time comes some of the other folks in his organization. But Ivan, I'd like to start off with you giving us your background and tell us the BAM Company's origin story, please.
Yeah, sure. Well, George, it's great to be here. I'm excited we get to spend a little time together. You know, I used to try to take you out to lunch maybe once a quarter, twice a year. And of course now, you know, things get busy and teams expand. So it's nice to be with you again. Let's see. So BAM actually started in 2010. I had just come through the GFC and working for Steve Pittman, as you know. My first, big time real estate mentor, great guy to work for, still buy him lunch any chance I get. But was the low man on the totem pole and got to learn some very formative lessons through 7, 8, 9, and 10, and seeing really front row to the correction, seeing what could go wrong in real estate, seeing businesses evaporate, marriages evaporate, and a lot of people getting caught swimming naked when the tide came in. And through that, I knew I wanted to own lots and lots of rental property, but I didn't yet sort of realize how to get there. But at the same time, my brother's going through the private equity sort of training grounds at IU, and then on to New York, Bear Stearns, Morgan Stanley, and on to grad school for him. And so sort of living vicariously through my brother, we're about a year apart, started looking at this private equity model just in general and seeing that all these great companies had management companies. So I thought, well, okay, I guess I should start a management company. At the time, I didn't really want to be a landlord managing the proverbial tenants in the toilets. But it seemed like I would have to do what I hate to hopefully eventually get to do what I love. And so I hung out a shingle as a management company. I had a broker's license, so I could manage third party. And I would manage basically anything I could get my hands on where I didn't have to carry a gun, was my little saying. And so, it was duplexes in up and coming areas. People were landing out of college, in the young urban areas, Broad Ripple, downtown, things like that. And what it allowed me to do was it allowed me to sort of scale a services business first. At the same time, I was putting together these little multifamily deals with hard money. I'd go find the worst piece of property, distressed seller in an area that I was convicted in was heading the right direction. But those deals took a lot. It took a lot of capital. I had to put a presentation together for the hard money lender, who was basically my one investor at the time. And I'd have to search through a lot of deals to find one that really made sense. where if I could go out and sell George to let me manage his 2, 4, 6 unit portfolio, I could get that cash flow coming in immediately. So first grew that and had a small but growing portfolio of apartments. I think that maybe 3 years into that, I bought a 35 unit deal in Beach Grove. I still remember getting an email from you congratulating me on that purchase.
That must have been the Francis, right?
That was the Francis Apartments. Yeah. You congratulated me, said that was going to be a good deal. Ended up not being it was an okay deal, but it was definitely a formative one where I learned a lot of lessons. And so I started slowly figuring out the management company side of things. Really started to bend the growth curve in 2015 when Adam Eric came along. So really more God at work than me, but figured that Adam could be a good partner. Turned out to be the best partner somebody could ask for. But he's really good on the operations side, the technical side, much better manager of people. And we had this idea, what if we had a management company where people like their job? What if we treated maintenance people like the gold that they're worth to the organization? And as luck would have it for us, we found a few more souls that believed in that idea of having a really great culture at the management level. And that's really how we started getting those early successes, was by really paying attention to the management. And because we had all that and we had already managed property for others, some of those others became our first apartment investors, as we syndicated one deal at a time. And we grew that to the point where we basically fired all the third-party management stuff. We decided we didn't like the third-party management. We had our own way of doing things. We didn't want to work for anybody else, but on behalf of our investors. And so we became just captive to our own assets. In late 2018, we had 2 deals land in our lab at the same time. And we did not have enough capital to get both deals done in 60 days. So we raised one with our investors, and we went to a private equity group for the other one. That was the one private equity deal I've ever done. With an outside group. And that was a never again moment. They weren't bad folks. It wasn't a terrible situation, but we felt terrible about not being able to offer it to our own stable of investors. So that's when we really got serious about the fund model. And that again changed the growth curve of BAM. We started putting portfolios of assets in discretionary funds. Today we're rounding third base, about ready to close Fund 4.
How big is that? How big will it be?
Fund 4, I think we'll end somewhere around 160 million of equity, just a little bit less than $500 million of real estate. Best vintages yet: Pittsburgh, Indy, Bentonville, and Kansas City. Some assets I'm still pinching myself that we've been able to acquire in this market. It feels to me again almost like it's 2010. A nice correction, a great time to buy, not a great time maybe to sell real estate, unless you maybe owned it for a while, but a very good time to buy assets. And that's the origin story, as short as I can make it.
Gotcha. So it sounds like the part of the business that you disliked the most, at least in the beginning, became the most important. That is the property management and operations, right?
Yeah, and it still is. It's not something I was particularly great at, but it is a nice badge of honor to say I've worn just about every hat in the business at one time or another. I think I got up to 70 units, George, before I hired anybody, which I would do that differently today if I had to. But it's the magic, not so magic ingredient to the sauce that executes the wealth strategy, the wealth building strategy for me and my family, and now almost 1,400 investors that come alongside us.
So think back to the first time you had to raise equity from somebody who wasn't already an investor or one of the persons you did property management for?
Yeah.
How hard was that? How hard was your first equity raise? and what were the challenges and what advice would you give to somebody trying to do that today?
Well, it was hard. It was stressful. I was on a timeline, and I had to raise, I think it was like $600,000 for Fox Hill Apartments, which was 60 units over
On the northwest side of Indy.
And come to think of it, I think that one was all management clients who said, yes, I'll put in 100, I'll put in 200. The next one, I had to raise $1 million, and I had about 40 days to do it. And that certainly was some new prospects that had never invested with me and I had managed for. It was tough. What got me through it really was just having enough people sort of in the pipeline, in the funnel to talk to. And so in those days, Adam was really good at making sure due diligence, closing timelines were met, property inspections, all those things that go into closing a deal. And my job was just to be there at the finish line with the equity. So I luckily got to spend a lot of time on the equity side. In those days, I was doing 2 lunches a day sometimes, breakfast meetings, coffee meetings, as many people as I could get in front of. And it was more of a soft sell. Just, hey, haven't talked to you in a while. Wanted to show you what I'm doing. Love to have you look at the business plan. Of course, if there's any interest, love to have you, but really just looking for advice. So my first CRM was just literally a note file in my phone of everybody that I thought was rich and successful in my network that I could call on for advice.
So did you cold call those people, or were they people that you already knew? And how did you come up with the list? I mean, I would assume back then your network of wealthy people was somewhat limited, right? So how did you build your network to be able to have enough potential investors to call on?
You're spot on. It was definitely smaller than it is today, a lot smaller. But I already had a head start. I've been working in real estate for about 8-9 years. At that point, 11, 12 years. And so I did have a network that I built up over time, people I'd sold land to, people that I'd met through former real estate gigs. Certainly started with all those folks. And a lot of times, so all these was warm network at first. If I wanted to talk to somebody that I hadn't spoken to before, I would try to get a warm referral. Hey, George, I see that you know Bob, and I'd really love to get in front of Bob and show him my real estate deals. Would you mind making an introduction? That sort of thing. And so I think it was quite different than what you might see today, where people start a podcast or they get on LinkedIn and just start posting anything they can about real estate. At the time, it was literally knocking on doors, buying people lunch, coffee, breakfast, whatever I could do to get on their schedule, and just talking about what I was doing. 1 out of 100 people might invest, 10 out of 100 or whatever it was. But it gave me repetition, practice on getting sort of my pitch down, what questions people might ask, what concerns they might have. Oh, George wants to know about the debt package. I need to put my debt package in my business plan, right? What could go wrong? I should add something in here about, what could go wrong in this. And just through the repetition and the tinkering and the iteration of it is how I got that early one done. But man, what a stressful time. Didn't sleep very well. A lot of pressure, and it was $1 million. And I look back, now we raise millions a week.
Right.
It's so different.
So back, I would say around 2015, when you really got started fast, we had very, very few Indianapolis-based syndicators, local people raising local money for more than just a small network of friends. So it's become a much bigger business now. So not only do BAM companies do it, but there's probably 5 or 6 or more local companies doing it today. Which you think it's harder today to raise equity? Forget about the state of the market. Just in terms of competition, do you think it's harder today or easier than when you first started?
And that's a great question. I think in a lot of ways, it's probably harder today to start, even with, even with the state of the market. Like if you take that aside, I think it's still harder today than it was. You've got a lot more competition, a lot more noise. And in some ways, it hasn't changed. You know, as you know, Indianapolis is I think a town that is underrated for how many great real estate families and operators there are across the asset classes. And I remember,
I was going to say, it's historically been private and closed, right? They would do their own deals.
Yeah. So I had the Barratt Stokelys, the Flaherty and Collinses, the Glicks. Like there were some really great real estate families to sort of model on what they were doing. Now they were raising capital maybe in a different way, but the peer set here is pretty intense. Right. And I think it actually helped in a lot of ways to have that sort of competition. The adage iron sharpens iron. Versus, I'll screw up the numbers here, but if I were to go to Kansas City, I'd be like the biggest owner in Kansas City. It's so much more fragmented. Versus Indy, I think I'm in the top 15. There's just so many big owners here, big real estate families that are great examples. Another one, Buckingham, Brad Chambers, right? Started in his dorm room. What a great inspirational story. Local indie story to have, like, back when I had nothing, to think, okay, if that guy did it just by putting his head down. And, in the beginning, my adage was no deal is too small if it's a deal, as long as it's 2 units or more. And so what I see today is a lot of syndicators, they want to go right into the deep end of the pool. They want to put a big deal together. And they haven't even learned to walk yet, let alone crawl. They haven't learned to crawl yet.
Well, so that leads me to another question. How did you make the transition from managing a bunch of small property yourself to the point where the properties were large enough you could hire professional staff? Because a lot of people say, I'm going to go buy a 10 or 20 unit property. And I remind them, if you do that, you're going to be there days and weekends and evenings leasing and fixing things because it's too small to hire somebody. So how did you make that transition from being a hands-on mom and pop to a manager of other people?
Yeah, I couldn't agree more with what you said. I try to preach this whenever I can. If you're in this business to learn how to be an operator and a sponsor and grow a company, you should absolutely buy some 10, 12 unit, 20 unit deals. But if you're not looking to actually be an active owner operator, like, stay the heck away from that stuff, because it's too big to run small and it's way too small to run big. So for me, the goal was always to get into bigger deals where I could get on-site staff. And so for me, it was a gauntlet, a trial by fire. Learn it here first, right? And transitioning from scattered sites to on-site staff, in some ways, is easier, and in other ways, it's tricky. And there's just a whole nother set of issues you have to learn. By the time we got our first on-site staff, that was really when Adam was coming on board, and
Muncie.
Well, he solved our Fox Hill problem by figuring out how to get a part-time staffer there. So we had somebody that's working part-time at Fox Hill, because 60 units is super tricky. I'd never buy another 60 unit deal as long as I live, if I can. It's just right there in the dead zone. But he's much better at managing teams and people and sort of being the even keel, steady she goes operator. And
So-
it's funny, the maintenance guys that were at Woods Edge, they were here today for a special celebration because BAM turns 14 this month. And so they actually came down. They're still with the company today. They've got different positions now. One of them's a regional. But we lucked out early on with some of the people we were able to bring on board and buy into the BAM fam and the culture here we've created on the management side, which so many other people get credit for that coming into reality.
Right. Well, congratulations on 14 years.
Thanks.
So does BAM companies have a niche? Do you have a niche that's different than some of the other syndicators, owner operators, other folks that you compete with and run into?
I would say in many ways, yes. Over the years, we've gotten much better at finding operational management plays where we're not necessarily buying older vintage assets and revitalizing them with physical improvements. We're buying much newer vintage assets and looking for undermanaged opportunities. The other thing we've been able to really perform well on is we're not just a property management company. We're not just a construction company. We're not just a capital formation. We're all three, and those things, those skill sets in each company really complement each other. So the BAM Capital is really all about being a good financial service provider to our investors, and that has its own org chart. The management company, same there. Their job, who they answer to, the culture there, and then the construction company, another really captive service provider to the whole.
Got you.
And a lot of companies my size that are putting $200 million out the door in a year, most of them aren't going directly to the retail investor, cutting out the middleman. Most of those real estate companies end up going to larger institutions or quasi-institutions where one person writes a check and the deal gets done. And we've stuck to our knitting and be able to scale a retail operation. Now, I think we're closing in on 1,400 investors across the country and even beyond now that we get the opportunity to steward their capital.
How big is your investor service department to handle 1,400 investors?
It's not small, George. It's not small. There's several people on the customer service side. Once you become a member of the BAM fam, certainly a few people on the business development side that are out there acquiring new customers and getting our name out there. It's quite an operation.
Tell us the pros and cons between raising money via fund and raising money via
Deal by deal.
Deal by deal.
Yeah, funds are quite difficult. You get a lot of smaller investors that are used to investing one asset at a time. So very hard to convert folks to a fund. The worry being that you're going to buy mediocre or worse deals just to get money out the door and collect fees. There's a lot more compliance. There's a lot more cost to it from auditing, compliance, administration. I wouldn't recommend anybody go for that or aim for that until they've got a pretty good track record. But once you're sort of mature enough as a company to execute, and the first one's always the toughest, just like raising your first $1 million. The first fund was considerably difficult. But for me, it's a lifestyle move because I no longer have to drop everything I'm doing and cancel vacations and things of that nature to hurry up and raise capital before the closing table. It lengthens my runway, right? For the investor, instead of it's pretty simple. Instead of saying, "Hey George, I can put your 200, your 500, your $1 million check towards this one asset," I can construct a portfolio of assets and spread your capital across several deals, several markets. That adds another factor of diversification. You're not taking single asset risk now. You're spread across a portfolio of assets. And then you no longer have to worry if this next asset is my home run, or you maybe missed my home run, or it's the next deal I do. The investor, as long as they trust us and our track record, doesn't have to worry anymore about which deal might be the best deal, because in a fund format, one's going to underperform. A few of them are probably going to do just about what we thought they were going to do, and then typically we're going to have one or two outstanding deals that perform in well excess of what we thought they were. And the individual investor now gets to take part in all those. So in effect, what I'm doing is I'm reducing risk, and I'm increasing the odds of a higher return. I'm not guaranteeing it. There's no guarantees, but I'm increasing the odds of a higher return. And those two things right there create alpha. And so from that standpoint, I wouldn't recommend most investors. I would recommend most investors go a fund format with a manager they trust who has a good track record versus trying to pick one deal at a time.
Gotcha. And what size investment checks are you typically either? What's your minimum and what's typical for, say, Fund 4, the newest?
Yeah, we now have 3 different strategies. We're doing joint venture developments where an investor can come in with as little as a $50,000 check. Our main fund is a $200,000 minimum. And we're in the process of rolling out a preferred credit fund, which is a perpetual vehicle with exposure to preferred equity and debt, be the bank.
Preferred equity of your deals or preferred equity in other deals?
Maybe both at some point, but preferred equity in future deals. So we've been raising preferred equity in-house now for almost 4 years, which a lot of people don't realize. We've put preferred equity in almost every deal we've done in the last 4 years, but it's not the expensive stuff that we don't go to somebody else that is looking to wedge themselves into my capital stack. We raise our own fair return preferred equities, I guess the best way I'd put it.
So the preferred equity has higher yields, but less participation in some of the upside. Is that how you structure those?
Exactly. We've got more investors that want a nice yield, don't really care about future upside as much. They're just looking to earn good yield off the capital they've already created. That's been a growing sector for us. So we're putting that into a perpetual vehicle where folks can stay in for 2 years or stay in for much, much longer. So those 3 strategies have different requirements. Anywhere, the main fund's $200K. The preferred credit fund is $250,000, and the other tripwire there is you've got to have a $5 million net worth to get into that fund.
Gotcha.
Where the other 2 is just a accredited investor standard as the minimum.
How do you finance properties? And I asked that question, and maybe it's changed over time, but in a situation where we've got, we know what the cap rates have been the last few years. They've moved up a bit, but interest rates have moved up more. So how have you handled challenging spreads between yields and cap rates and cost of debt?
Lower leverage, more equity, and there's got to be a way for us to pop the NOI. I mean, that's the simplest way I can say it. Now, it's not easy to find always, but so we'll take negative leverage out of the gate if we've got the ability to get a stabilized yield much higher.
Okay. Is that how you do the new development JVs?
No, the development JDs are certainly looking at stabilized yield on cost as well there. But I was more referring to an acquisition of an existing asset. So we've got to know that bringing in our management team, we're going to be able to reduce costs and we've got to see the ability to raise rents as leases turn over, whether through maybe some minor physical improvements, but usually just because the market we're going into has momentum. Suburbs of Indianapolis are a great example. We found some opportunities out in Des Moines, Iowa. We put a big bet on out there as well.
Gotcha.
Yeah, but you've got to be able to raise more equity in this market. We're very, I hate to keep saying lucky because the credit goes to the asset management side of the house, but we went into this phase of the cycle with almost, I think we were almost a 1.9 debt cover, and we had a lot of cash in the funds. That's another pro of the fund that I failed to mention earlier, is that we tend to keep more cash on hand in the fund. We don't distribute everything. And it's in that rainy day fund, whether it gets used for CapEx, unforeseen issues, rising interest rates, all kinds of things. You got cash on hand, you can weather the storm better than, say, going out and financing to a 125 debt cover, with only bank reserves in liquid form, and crossing your fingers, nothing goes wrong.
Gotcha. Now, what kind of yields are you, I don't want to say promising, I don't know that promise is the right word.
Yeah.
What kind of yields today versus, say, 2 years ago in order to raise the capital?
Well, what benefited us greatly was when we started raising pref equity. So the way we would raise a typical fund is, in the past, is 2 share classes. So if you're looking for cash flow, you can invest and get 10 to 11% paid monthly from the start. Okay. And that's, we might only allow 30% of the equity needed to go to that classification. And then the balance of the equity would be common equity. And we tell those investors, you're buying growth. Don't expect any cash flow in the early years. A little bit of cash flow, maybe year 3, year 4, and beyond. But you're looking, if you're buying those shares, you're looking for the biggest pop on a capital event, on a sale or a refinance. And so splitting those two investor appetites, or allowing for an investor to blend both cash flow and growth. And that allowed us to 2020, 21, 22 to find deals that would fit in the buy box much better than offering everybody cash flow participation at the front.
Gotcha. So what does BAM companies look like 10, 20 years ago? Where do you want to take the business?
Oh gosh, 20 years from now, we are definitely a multi-billion dollar investment manager across several strategies. I would bet that the majority of those strategies are still going to be related to housing, although you could see some adjacent strategies to that down the road, but nothing off the top of my head what that might be.
Other product type, you mean? Other commercial real estate?
Oh, never say never, but I would think most of the strategies still going to be involved in housing. So right now, joint venture development, common equity, preferred equity, and then the new perpetual vehicle. Those are all still are securitized by what I would argue some of the best multifamily that you can buy. This all really changed about, 10, 12 years ago now with the Jobs Act, where I can cut out the middleman and you can participate with me in assets. I mean, gosh, like what's the latest one? I think you guys sold us, Flats at Fisher's.
Flats at Fisher's Marketplace. Yeah.
I mean, that's the kind of deal that used to be only available to much larger investors, pension funds, sovereign wealth funds, ultra wealthy families. Now I can offer that to someone who's writing a $200,000 check to participate. And it's fun.
So in 10, 20 years, you're going to have the same structure. You're just going to have, it's going to be fund number 10 or 15?
Fund number 30 by then, George. No, no, you and I've talked about this before. Aggressively pursuing semi-perpetual vehicles for long duration assets that we want to hold on to. So is everything going to go into that structure? No. But if I can take a bunch of assets, I can crystallize what the LP is earned so far, and I can put that in a perpetual structure, which is not a taxable event. I can continue to defer taxes and put it in a perpetual or semi-perpetual structure where investors that want to liquidate can choose the time of their liquidation and manage their taxable event. And investors that want to stay in it for long term, maybe it's a legacy play, because those vehicles also allow a step up in basis at your time of passing. I can solve a lot of issues for my investors. So the guy that wants to take his marbles and go home can do just that, and the family that wants to pass it along to their kids can also do that. And so having that optionality is very exciting.
How do you know when to sell a property?
When Adam tells me to.
And what is his basis
I thought
for that?
It's so hard to get a laugh out of you, George. There it is. No, I mean, in the past, it's been, can we deliver two or more times investors' capital, right? George put in $100,000. Can I return him net of fees $250,000, right? And the prepayment penalties burned off. That's usually when we'd sell things. As I turn 46 this year, and hopefully, continue to get a little bit more wiser, I am more interested in my total after-tax return.
So does that mean hanging on longer? Does it mean, are you waiting for 1030? Are you doing 1031 exchange structures?
Yeah, I think it'll allow us to hold assets that we want to longer. There'll still be plenty of reasons to sell plenty of assets along the way. And then in a lot of cases, be able to exchange in and out of those assets to continue to defer taxes, for sure.
Okay. So have you been doing 1031 exchanges? I don't think you have you?
No, not yet. I've just been a straight seller.
Right.
Yep, using the losses from new assets to cover over the gains from old ones. So getting some 1031 effect, but without going through the hoops.
Gotcha. Hannah wanted me to ask you this one. So you were in YPO, right?
I am in YPO, yeah.
Are you in any other executive level organizations, and how important has that been in your career?
Oh, hey, Hannah, you've got good questions. I'm also in a group called Tiger 21. I think, so I get this question a lot, and my default answer, especially with young entrepreneurs most of the time, is two things. My two defaults are personal coaching and peer groups. And so if you're only going to do one of those things, I would say peer groups all day long. But being around other people, other like-minded people that are looking to do the same things you're looking to do, or some of them maybe are higher up the mountain than you, is a tremendous benefit. Peer groups are huge for me. I've been in groups now, 10 years. Yeah.
Sort of national groups, real estate.
YPO's global, Tiger 21's global. There's some subgroups in there. YPO's got a great real estate network, lots of access to all-star, world-class CEOs that now I can get on the phone and ask for advice. Before YPO, I was in EO. That's a smaller threshold to qualify for EO, but that's great for younger operators or entrepreneurs. There's a chapter here in Indy. So I was in that for a while. Then I was eligible for YPO, so I joined YPO. That's a membership I'll never let go of, because there's just so much value there now for my family and for business. And then Tiger 21, a lot of YPO folks in that. just a different set of issues we're learning and growing in together.
Gotcha. So it's a subset of YPO?
No, it's a different different peer group, but there's a lot of YPOers that have joined it.
Gotcha. Okay.
Thanks, Hannah.
What is the biggest, or what are 2 or 3 of the biggest mistakes that you've made that you would share with other people to help other people avoid from making those?
Are we talking real estate only or just life in general?
Let's stick with real estate. I won't ask you life in general unless you want to share, but let's talk real estate and business.
Yeah. Gosh, I mean, I learned so much on the Francis apartments. That was a big jump. I mean, the biggest thing I had before Francis was a 6-unit, which, that one was more like running 3 duplexes right next to each other, even though it was like a 6-unit building. Francis, 35 units, common hallways, laundry room. I mean, everything that could have gone wrong went wrong on that deal.
70 years old.
Oh, so old. Sewer lines collapsing, drugs, bed bugs, homeless people sleeping in the laundry room, more bed bugs. I think we had a suicide via heroin overdose. I mean, just all kinds of crap. I got my, handed to me several times, and still sold it 5 years later for a 9% IRR. So, it was rough, but I learned that, I thought of it as paying tuition, George.
At the time, you probably weren't thinking that, right? You were thinking, "Oh my God."
Well, I knew I was going to make mistakes, and I figured I might as well make them on smaller deals before I go off and really start trying to raise a lot of capital on bigger assets. I just didn't know how many mistakes I was going to make. I'm a fire, ready, aim kind of guy.
Right.
And that served me pretty well. But if you're that kind of personality, I had to also be ready to get hit in the mouth on a daily basis and have to pick myself up off the mat. I bought a deal where I thought I could renovate out of cash flow. That was a huge mistake. That was a big one.
Heard that one a few times.
Yeah, don't ever renovate out of cash flow. I'm lucky I made most of the mistakes on smaller assets. I think my first fair housing lawsuit was on a deal I was third party managing, and the lady got super upset with us because we put mouse traps in her, like under her sink to try to like catch some vermin. And she was emotionally disturbed by the thought of us torturing little rodents.
Oh gosh.
And that blew up in my face, but I reminded myself it was only a matter of time. Everybody's going to get a fair housing lawsuit eventually. And that took a while to get past. If I had a time machine, I just probably would have tried to talk my way around that one and said, okay, we'll put in some non-lethal traps.
You never know those in advance, though, right?
Yeah. It's I think what everybody's learning right now is that this can be a great investment, and it can be an asset that can really do well for your family, but it is not freaking easy.
Well, and what some people don't realize, especially private investors, it's an operating business. It's not just an asset.
That's right.
It's an operating business.
It's truly an operating business, and it's intense.
So I want to end this on a positive note. So other than teaming up with Adam, what are the things you are most proud of, and what are some of the best things you've done?
I am super proud of the culture we have at BAM and our core values and the people we have here. And I get a little credit because it was sort of my vision to have a management company where people like to work. But the majority of the credit goes to the folks that really took that baton and believed in it and ran with it. And so we just got some incredible people here that live and breathe that every day, that have made that a reality. just to hear the testimonies from maintenance folks that have never seen or experienced a company like ours in their 10, 20, 30 years of being in the business. To have people go on and on about how much they enjoy working here and being part of the BAM fam. It's like a fourth child in many ways. And now at 14 years old, it's really getting mature, and I'm sure it's still making its mistakes and it's getting bruises and getting banged up every now and then, but it's continuing to make even better decisions without my involvement as much. The powerful thing though is that it's not just like, yes, it seems like an organism and I'm like a proud parent, but inside there now is like 170 people with families, right? Individuals and families that we get to impact. And it's not easy, but it's pretty simple. And if we continue to treat those people well, they'll do well by us. And so this symbiotic relationship can keep growing if we're intentional about it.
Well, congratulations, Ivan. Our team has done 9 or 10 deals with you and your team, and they've all been terrific. We've only had good experiences with BAM, and we're looking forward to doing, many more deals as you continue to grow.
Same here.
Is there anything else you want to say to our clients and the people who might see this?
Well, do we have a few minutes here? I mean, we do. Recording this. It's July 15th. What are you guys seeing out there? It seems like maybe there's people coming back into the market. There's maybe some interest. I mean, transactions have been down so much, which has opened up some opportunities. At the same time, a normal market would be nice.
Yeah. Well, who knows what normal is? Ivan, I don't think 21 and 22 were normal. I don't think 24 is normal, but I don't know what normal is.
Yeah.
Markets just evolve over time. So we've seen a lot of people still in the market. They just haven't been executing, but they're waiting.
Yeah.
And I think we're getting closer. Again, the fact that interest rates have been higher longer than people expected a year and a half ago. And now it looks like we're getting closer to that declining interest rate, maybe rates getting closer to a level to where somebody who needs to refinance can.
Sure.
To unstick the markets. So we think as 2024 progresses and we get into 25, we're going to see more activity.
Yeah. Good.
So, and we're looking forward to doing more deals with you. It's been a little while.
It has. We got some great deals early on. But you guys have a lot more older vintage stuff coming to market right now.
Well, we've got everything. We've got 2 brand new properties coming. So,
oh boy,
it's week by week. You never know what's coming, but we've had pretty good product. But a lot of what we've done the last 6 months has been some older stuff, but we got new stuff coming.
Well, if it's 2015 or newer, we start looking at it pretty close.
Yeah, we've got some brand new things coming. So we look forward to doing some deals with you soon.
Yeah. It's been a while since we had a closing dinner.
Yes. Well, Ivan, thanks so much for your time. Again, so impressed with the organization you've built, and pleased to call you a friend and a client. So all the best wishes for the remainder of 24 and future years.
Likewise, George. We wouldn't be here without you guys. It takes a village to make it all work, and just frankly, all the market share you control. There's no way we'd get here without the Tikijian team.
Well, thank you.
Thanks for tuning in. Stay in the loop by hitting that subscribe button. And check the show notes for additional resources.